You had kind of foreshadowed this earlier, so I'll kind of switch gears and just jump right into it. There's an article in the Telegraph called "Investors Pay to Lend the Treasury Money as Bailey Hints at Negative Rates." And so what's happening is that in the UK, the Bank of England governor is revising his stance on the possibility of taking rates below zero. This is the first time in UK history, I guess, that this has happened. And what's happening is people are so afraid about the future of their currency and of their money that they're willing to pay basically a small insurance premium in the form of interest expense on the deposits that they hold, either with the bank, and it also talked about with bonds and other financial instruments getting affected by this as well. It talked about how inflation had plunged to near a 4-year low, which made bonds come with less worry because they weren't as afraid that they would get devalued over time. And the interesting thing is the article kind of made it sound like he was taking that stance, but when you read the headline, it sounds like the governor is going to say, okay, we're going to do negative interest rates. But when you read it more carefully, what I found is that what he was really saying is that we're going to not rule out any possibility of any move that we might do to solve this, because this is a different time and we need to be taking this as a chance to kind of reevaluate our tools. And so I thought about that, and I was wondering whether or not you guys feel that a crisis is a good time to kind of reevaluate your tools. Because on the one hand, it seems like, yeah, it's a crisis. We have to do something drastic, so we should be looking at any option. But on the other hand, it's difficult to try new things and do new maneuvers during a time of crisis. And so I just kind of want to get your guys' take on whether or not now is the time to do negative interest rates, or in general, just revise our strategies on things.
I think negative interest rates sound very intriguing to me, and this topic has come up in the U.S. as well, and just it's just interesting in the sense of I don't have a clear picture of exactly how it works. I have a feeling that there's so many banking layers between, for example, if this were to happen in the U.S., there's so many banking layers between the Federal Reserve and the end user of money that it doesn't truly result in a borrower getting paid to borrow the money. I think is my guess is that there's a bunch of middlemen taking cuts out of that until what it really results in is an extremely low rate or a rate near zero or whatever, right? But I think that I think it, the concept, setting that aside, the concept of essentially paying people to take money and use it is a very interesting concept. And I guess philosophically, in my mind, it would depend on what they're using it for. I think that paying people to take money and use it to build businesses or take risks that employ people and things like that sounds like it could be a very interesting strategy. Paying people because remember when we say we're paying people to borrow money with negative interest rates, the catch to this is the people still have to pay the money back, right? They get paid to use the money, but then they still have to give the money back at some point, right? And so if it becomes like, I think people getting paid to take money and then use it, say as consumers, people who otherwise would not be able to pay that money back. I don't know that necessarily helps anything. So I think it's those are kind of some of my initial thoughts on it, but just really not knowing anything about it, those are some things that just come to my mind.
Well, I mean, the other interesting thing is like that also happens on your deposits. I've seen it happen in the EU where other non-UK EU countries had implemented negative interest rates on deposits. So basically, by just having some money in the bank, that's all you had to do to participate in this. I don't want to call it a phenomenon, but to participate in negative interest rates, you just had to have a little bit in the bank, and you just get hit with an interest charge. And so, yeah, the mechanics of kind of how it plays out are interesting to say the least. Yeah.
That part's a little bit easier to understand conceptually in my mind, is like, because you can analogize it to like a storage fee, right? It's like, hey, you're warehousing my money for me, so I'm paying you a warehousing fee to keep it, kind of thing, right? Because if you literally, like, let's say that you had like truckloads of bricks of gold and you weren't burying them in the backyard, you'd have to house those somewhere, probably with some type of security, and you would pay for that warehousing of that asset, right? So that that part is not as much of a mind work for me. The idea that you might have to pay somebody to store your money, if it results in the same overall incentive, though, right? The incentive is it's not only, hey, maybe you should borrow money and spend it because you get paid for it, but also if you just have a bunch of cash sitting there, the incentive is, hey, you shouldn't be paying to warehouse it. You should be spending it on other assets that are valuable or that move things forward without you getting hit with that charge, right? So I think from a business perspective, it should have the same incentive, right? It should stop. It's very interesting because we had a topic previously on this podcast, and we had some content that got derived from that topic, and it actually brought up some interesting conversation on LinkedIn, because I had made the statement that in recent history, we want companies to spend money. We don't want them to sit on cash. We want them to spend money. And, we don't want them to just sit on cash because, they're only helping themselves when they sit on cash. They're not really helping the economy wide, right? In terms of taking risks and growing and stuff like that. And I got some pushback from people saying, well, smart companies or financially prudent companies are those that are conservative or are good at managing their businesses, are saving cash reserves. And the ones that did that are now in better circumstances. Because the context of me saying that was, let's not browbeat these companies that ran out of money during this crisis because they didn't have big cash reserves. They were doing what we'd want them to do. We don't want companies to just sit on cash. And then the pushback was, well, had they sat on cash, they would have been able to weather this better, and that would be more financially prudent and all that. But I guess I would point out that these central banks talking about negative interest rates are promoting exactly what I'm saying. They're telling companies, they're telling businesses, we don't want you to just sit on cash. That's what this is about.
I also think that size, when we had that discussion, we talked about size mattering, where if you were a larger company, you were probably even more, or a publicly traded company, you were probably more at odds by having a large cash balance because you weren't paying out dividends or reinvesting it in the business or reinvesting in your workers or reinvesting in your R&D. And I think it's true here where you're talking about large depositors having large balances at the bank. This kind of negative interest rate is going to affect them much more. It's going to turn them into trying to invest that into a market to make money in a different way other than just warehousing it for safekeeping. And same thing true with business. If you're sitting on a cash reserve, now you're being penalized for doing so. So it'll be interesting because I don't think we've seen a long sustained portion of negative interest rates. We haven't seen negative interest rates in the US ever, I don't believe. So, I guess it'll be an interesting, fiscal monetary policy change.
The other thing I noticed that I just want to bring up here is it was a different discussion and a little bit of a different topic, but it seemed to have the same theme, which is when we were talking about when major airlines would get bailed out with government money and then would use all that money to buy back treasury stock as opposed to investing it in assets or doing something else with it. Seems like kind of that same thing. It's a question of whether or not the company is going to sit on that money or do something with it that we believe will further the economy, or not we, the pejorative we, as in the people giving them the money. So yeah, interesting topic.
Yeah, I think that's a variant of the point of that paying people to borrow money depends on what they use it for. And I think what you're pointing out is you can try to regulate that, but then companies can potentially skirt it, right? I mean, they can essentially take that money and then, by various mechanisms, just siphon it off to shareholders and not do anything necessarily productive with it. And then the shareholders ultimately have to do something with it. But, if they're subject to the same, what's interesting about that, if they're subject to the same negative interest rate scheme, then the shareholders don't have an incentive to just sit on it. But then it's, well, what do the shareholders do with that money? if they start other businesses or they deploy the capital in their businesses, then maybe that works out fine. But if they use it to buy bigger mansions or go on vacations or things like that, then yeah, maybe not so fine.
Well, even then, at least they're spending.
Yes. Yeah, at least they're spending, but yeah, they're leaving somebody with the bill to have to pay all that money back somehow.
Totally.
It's like one giant shell game where they're just passing the money back and forth.
That's what it is.
Right.
Yeah.
Right.